If you are 60 or older and living in Canada, there is a very good chance that your age has already opened the door to benefits, pension options, tax breaks, or government payments that you may not be taking full advantage of. And the surprising part is that turning 60 does not mean one single check suddenly appears in your bank account. Instead, different age milestones can unlock completely different programs, and missing the right window can sometimes mean leaving money on the table. So if you are 60, 61, 62, 63, 64, 65, or even 70 and beyond, stay with me, because today we are going through the age-based money opportunities Canadian seniors should know about in 2026. And the first one is especially important for people between 60 and 64, because many people assume that nothing major is available until they reach 65. That is not always true. If you are between 60 and 64 and your spouse or common law partner receives the guaranteed income supplement, you may qualify for the allowance. This is a monthly payment designed for lower income spouses between 60 and 64 who meet the eligibility rules. In July to September 2026, the maximum allowance is up to $1,428.06 per month, depending on your circumstances and household income. That is a substantial amount of money. But there is a catch. You do not qualify simply because you turned 60. Your age is one part of the eligibility requirements. Your marital situation, your spouse or partner's benefits, your residency, and your combined income also matter. And there is another age 60 opportunity that many families never think about until it is too late. If you are 60 to 64, your spouse or common law partner has passed away, and you meet the other requirements, you may qualify for the allowance for the survivor. For July to September 2026, the maximum payment is up to $1,702.34 per month. Again, this is not automatic money for everyone over 60, but if your circumstances match the rules, this is exactly the kind of benefit that deserves to be checked instead of assumed to be unavailable. Now let's move to the age milestone that most Canadians immediately associate with retirement income: 65. At 65, you can become eligible for Old Age Security, or OAS, provided you meet the residency and other requirements. And here's something many people get wrong. You do not have to have worked your entire life to receive OAS. OAS is not based on your CPP contribution history. If you meet the eligibility requirements, you can receive OAS even if you have never worked or are still working. For someone living in Canada, one of the basic residency rules is generally at least 10 years of residence in Canada after age 18. If you have lived in Canada for less than 40 years after age 18, your OAS may be a partial pension rather than the full amount. And what could OAS look like in 2026? For July through September 2026, the maximum monthly OAS payment for someone aged 65 to 74 is $751.97. For someone aged 75 or older, the maximum is $827.17. These are maximum amounts, not guarantees, because your actual amount can depend on your circumstances and eligibility. But here is where your age can become especially interesting. You do not have to start OAS exactly at 65. If you are eligible, you can choose to delay it as late as age 70. For every month you delay after 65, your OAS increases by 0.6%, up to a maximum increase of 36% at age 70. So, in simple terms, waiting from 65 to 70 can produce a significantly larger monthly OAS payment for the rest of your life. But that does not automatically mean waiting is better for everyone. Your health, income, retirement savings, tax situation, and whether you qualify for GIS can all affect the decision. In fact, the government specifically notes that people eligible for GIS should consider whether delaying OAS makes sense, because there is no benefit to delaying OAS if you are eligible for GIS. Now, let's talk about CPP, because this is another place where your age can directly change the amount you receive. CPP can start as early as age 60, but starting early means a smaller monthly payment. If you start CPP before 65, the pension is reduced by 0.6% for each month you start early, up to a maximum reduction of 36% if you start at age 60. On the other hand, if you wait beyond 65, your CPP increases by 0.7% for every month you delay, up to a maximum increase of 42% at age 70. So two Canadians with similar contribution histories can potentially receive very different monthly CPP amounts simply because they chose different starting ages. And this is why one of the biggest mistakes is thinking, I'm 60, so I should start CPP immediately. Maybe you should, maybe you should not. The correct answer depends on your circumstances. If you need the income immediately, starting earlier may be appropriate. If you have other income and want a larger guaranteed monthly payment later, delaying could be worth considering. The important point is that your age is not just a number on your birthday card. It can change the calculation of your retirement income. For 2026, the maximum CPP retirement pension at age 65 is listed at $1,507.65 per month, while the average amount for new beneficiaries at age 65 was $877.01 in April 2026. Your own CPP can be much lower or higher depending on your contributions, earnings, and starting age. Now here's another age milestone that lower income seniors should pay close attention to: 65 and GIS. The Guaranteed Income Supplement is a monthly tax-free benefit for eligible OAS recipients with lower incomes. For July to September 2026, a single, widowed, or divorced person can receive up to $1,123.17 per month, depending on income and circumstances. If you have a spouse or common law partner, different income thresholds and maximum amounts apply. And this is where something very simple can have a very big impact: your tax return. GIS is income tested, and the government recalculates GIS payments each July based on the previous calendar year's income. That means the information on your tax return can affect the benefits you receive. If your income changed significantly, if you stopped working, if you separated, became widowed, or had another major change in your circumstances, do not simply assume your previous benefit amount will continue forever. Check your records and make sure Service Canada has the information it needs. Now let's talk about another age-based opportunity that does not arrive as a government check, but can still reduce the amount of tax you owe. Once you reach age 65, you may be eligible for the federal age amount tax credit, depending on your income. For the 2025 tax year, which is relevant to tax filing in 2026, the CRA says generally that you can claim the age amount if you were 65 or older on December 31, 2025, and your net income was below the applicable threshold. The maximum federal amount for lower income seniors was $9,028 for that tax year, with the actual credit depending on income. So, if you are 65 or older, do not think only in terms of monthly pension checks. Money you keep by using credits and deductions can be just as valuable as money deposited into your account. This is why seniors should look at their complete financial picture instead of checking only CPP and OAS. Now, let's jump ahead to age 70, because this is another major point where waiting can change your monthly OAS and CPP. If you delay OAS all the way from 65 to 70, the increase can reach 36%. If you delay CPP to 70, the increase can reach 42% compared with starting at 65. But again, this is not a universal recommendation. A higher monthly payment later is valuable only if that strategy fits your life. Someone with limited income today may need the money earlier, while someone with savings and other income may prefer a larger guaranteed payment later. And there is one more thing people over 70 should know. There is no financial advantage to delaying CPP or OAS beyond age 70 because the maximum increase is reached at 70. So, if you are approaching 70 and have not started one of these pensions, this is a good moment to review your situation rather than simply waiting because you think the payment will keep increasing forever. Now, let's put all of this together. If you are 60 to 64, look carefully at the allowance and allowance for the survivor if your personal circumstances fit. If you are approaching 65, prepare for the OAS and GIS eligibility milestones and make sure your Service Canada information is accurate. If you are 65 or older, check whether you are receiving all the benefits you qualify for and whether you are using the tax credits available to seniors. And if you are approaching 70, review whether delaying CPP or OAS still makes sense for your situation. The biggest lesson here is that there is no single senior benefit that appears at one magic age. Canada has multiple programs, and your age can interact with income, marital status, residency, employment, and contribution history to determine what you can receive. That is why two neighbors who are both 65 can have completely different government payments. One may qualify for GIS, another may not. One may have delayed CPP, another may have started at 60. One may receive a full OAS pension. Another may receive a partial pension because of their years of residence in Canada. And one may be claiming tax credits that the other never checked. So before you assume that your current monthly income is all you are entitled to, take a few minutes to review your age, your CPP start date, your OAS status, your GIS eligibility, your income, your marital status, and your tax situation. If you are 60 to 64, especially check the age-based benefits that apply before 65. If you are 65 or older, check OAS, GIS, and applicable tax credits. And if you are close to 70, make sure you understand the financial trade-off of delaying your pensions. Your age may not put money into your account automatically, but it can open doors that were not available before. And the people who benefit most are often not the people who simply wait for a letter. They are the people who know what to check, understand the eligibility rules, and make sure they are actually receiving what they qualify for. If you found this useful, share this video with a parent, spouse, friend, or neighbor who is over 60. Because the person sitting next to you may be missing a benefit simply because nobody told them to check. And remember, these programs have specific eligibility rules, so always confirm your individual situation through Service Canada or the CRA before making a financial decision.